Recession fears, inflationary pressures gripping the markets. But your next guest says pundits sounding the alarm and calling this a bear market are just wrong. Says the recent volatility is actually just a correction related to Fed tightening. And since the worst of the pain may be over, it's time to reduce cash and start buying into equities again. Let's bring in Barry Knapp, managing partner and director of research at Ironsides Macroeconomics. So, Barry, so you think basically, and I'll summarize shorter Barry Knapp, which is basically all that the market has already reacted to probably 1.5% to 2% more Fed tightening.
Yes, I would. That's a fair way to characterize my view. We pretty much know what the Fed policy path is for the balance of the year. We know they're going to go another couple of 50 basis point hikes and then probably slow it down to 25 while they get to the maximum caps and balance sheet contraction. The Fed policy path, that terminal funds rate, has actually been generally falling over the last 3 or 4 weeks or so. The market's probably got ahead of where the Fed's going in terms of rate policy. I think the market underestimates the impact on longer-term rates of the Fed starting to wind down their mortgage-backed securities portfolio. In fact, if you go back to Steve's Fed challenge in that previous segment, I would have given extra credit if any of the groups had said, sell mortgage-backed securities. That
Not just
really
sell
been
bonds.
the right answer. Not just sell bonds, not sell treasuries, but sell mortgage-backed securities, because that would help a lot in cooling off house price inflation.
That's a fair point, because that's actually where the Fed's money goes. And I want to talk about money, and I have a chart here. It's money supply. I'm sure you know it in your head. Money supply for 10 years, M2, against the S&P 500. It's a rough chart, but you can see as money supply goes up, stocks tend to go up. I'm worried about the far right side. Money supply is starting to come down. How does the market go up if money supply comes down?
Well, I think it's important to realize that the actions of the Treasury in 2021 and thus far in 2022 were far more impactful than the actions of the Fed. So last year, the Fed bought $1.4 trillion in treasuries and mortgage-backed securities, but the Treasury unwound, released liquidity into the system to the tune of about $1.8 trillion over the course of 6 or 7 months, right? And that's their account they hold at the Fed. They stopped issuing Treasury bills. That balance fell sharply. That caused a huge liquidity flood into the market. It's no coincidence that when that was at its peak in March, April, May, and June is when crypto went crazy and meme stocks went crazy. So some of this money leaked out the side. Well, thus far this year, they've raised that balance in that account at the Fed back up to $950 billion from something like 50. So they've already done far more than the Fed's going to do through the balance of the year. That's the liquidity part of the story that already effectively we've had a QT, at least in terms of overnight bank liquidity. Bank reserves, for example, or reserves held at the Fed have fallen by $1 trillion from 4.43 to 3.3. What the Fed's going to do is a much slower pace than that. So we've already had the liquidity shock.
Still big numbers. We'll get to your themes next appearance. Barry Knapp, thank you very much. Ironsides Macro. Love it.